this is happening when?
It's happening in March.
So what can we expect? Lower earnings per share across the board?
You're going to expect companies to continue doing what they've been doing so aggressively in the current fourth quarter earnings season. And that's that you get an earnings report accompanied by another line item that says, and we're going to do big layoffs to cut costs.
We're back at the Vancouver Resource Investment Conference. Joining me today is Danielle DiMartino Booth, CEO of QI Research. Viewers of my show will have seen many appearances of her on the David Lynn Report. Welcome back.
It's great to be here in Vancouver.
Great to see you in person.
Indeed.
Looking lovely as always.
Thank you very much.
You know what's not lovely, according to your slide deck that we're going to talk about, is perhaps the economy. You know, consumer sentiment seems to be strong, according to some statistics, and we'll talk about what you found. I polled the audience at a panel I was at earlier. I said, how many people here are concerned about layoffs this year? Not a lot of hands went up. I said, how many people are still spending money on restaurants, vacations, retail, shopping? Quite a few hands went up. Consumer sentiment, according to the Michigan survey, is going up. What's happening?
And it went up a lot.
Yeah.
And the beauty of the University of Michigan is it's been around for a really long time, since the 60s, and they have really granular data. So you can like peel the onion back and figure out where's the enthusiasm coming from. Why are consumers excited? Consumers are excited because they're like, the Fed's going to take interest rates down to zero, boom, credit's going to get easier again. And that's why they're excited. It's like this.
Whoa, so hold on, people are expected to go down to zero?
Well, people are expecting dramatic rate cuts,
right,
because that. Look, if you're 20 years old or 30 years old or 40 years old, that's all you've ever known. You've only ever known an aggressive Fed. There's no like a quarter percentage point rate cut, maybe 3 of them people are used to the Fed slashing and burning 1 percentage point at a time, 100 basis points, just taking it down to zero. That's what generations have been trained to expect.
Okay. You have a slide deck here. Google search can't pay credit card going up. Google search give car back going up.
Give car back. I mean, and that's a quote.
Yeah.
People don't understand that when there was this exodus from urban centers, which in many ways is reversing right now, but when all these people left the cities and bought cars for the first time because they were outside of cities, they couldn't take the subway or whatever, or Ubers, that these car payments were like a thing.
Right, yeah, of course.
You can't just give your car back.
Yeah.
It's called a repossession. And it's as damaging to your credit report, 7 years, as losing a home would be. But there's the 20-year-olds and the 30-year-olds, the reason that they're adopting buy now, pay later so aggressively is because they don't know where to get the money to live.
But why is this happening? Mortgage rates are falling, interest rates are supposedly going to fall.
Well,
why are people still concerned?
Well, in the University of Michigan, the one thing that did not move,
yeah,
with all due difference to your audience,
sure, yeah,
was expectations for a rising unemployment rate in the next year. It didn't budge.
Interesting.
So, and another survey that came out last week, similar type of questions that were asked.
Yeah.
So 45% of the people questioned were worried about losing their job this year.
Sure.
Compared to 37% a year ago.
Yeah.
So that's, you're almost hitting that 50% threshold, and you're not going to find it here at a conference. I mean, people got on an airplane, they ate out dinner last night, they're still traveling.
Yeah.
But these are other, if there's one thing that I have noticed since the start of the year, it's the fanning out into other industries of layoffs. This is not contained to Wall Street and Silicon Valley. In the beginning, when it was Amazon doing the first round of layoffs in November 2022, it was really isolated to white-collar jobs in Silicon Valley and on Wall Street.
Right.
Now, initial jobless claims in the state of Michigan are up 200% year over year. Mm-hmm. Michigan. So it's like, okay, so we settled with the United Auto Workers, the strike's over, and that's what we're seeing. And we're seeing auto suppliers get affected, and we're seeing manufacturers announce layoffs, and you're seeing it, and it's a global phenomenon. BASF is the largest chemicals company in the world in Germany.
Yeah.
They just put through big layoffs.
Layoffs
the
are still
cyclical
happening.
manufacturing industrial recessions, global, But the difference between 2022 and 2023 and where we are today is that I'm seeing hospitals, education, all kinds of industries get folded up into layoffs.
Yeah, the tech layoffs are still happening, by the way. Google, Amazon, just recent
Amazon
news,
just went through their third wave.
Yeah.
So there's a company that's really good. You should follow them on Twitter, Warn Tracker. And Warn Tracker, they actually follow companies warning that they're going to do layoffs. And the state of Washington, where Amazon is based, was it was the number one state for layoffs last year.
Yeah.
Where they were the most aggressive. And it's just remarkable to see that the company that started layoffs in November 2022 by announcing that they were going to lay off 10,000 people in technology and in their headquarters, Amazon, that they're going through their third wave.
Mm-hmm. I'm going to come back to this, but let's back up. Let's talk about Fed expectations, because you brought that up.
Fed expectations, yeah.
Yeah, the notion that the Fed is going to reduce rates, that's what consumers are expecting. What are the markets expecting? Yeah.
But investors to a lesser extent. But
right.
You have to remember, there's always an order of things, right, David? It's always that Wall Street finds out first, and then Main Street finds out later.
Sure.
So what if Main Street's finding out a little bit too late? Because a week ago Friday, there were 7 rate cuts priced in for 2024.
That's right.
And now there are 5.
Yeah. So CME Fed Watch Tool, I can't remember the number. It's like 49% last week. It's now at 40%. So big jump in just a couple of days.
And this is for the March meeting. And I think that Powell wants to avoid cutting. I think if Powell can get all the way to May, then he will feel like he's secured one victory.
But why are expectations for a March rate cut being reduced as we speak?
You just told me consumer confidence went up. And we know that, I've got some other slides that show that, we've had 12 solid months of negative revisions to private non-farm payrolls, like negative 48,000 on average per month in 2023. You got to go back to 2008 to see those numbers when Lehman declared bankruptcy. But yet, what do consumers hear? Does your average working man or woman on the street, do they know about these negative revisions?
You've worked for the Dallas Fed. Tell us, what do they look at in terms of data that would signal rate cut now or rate cut later?
Well, what they're seeing and what they're using is justification to stay high for longer, not higher anymore, but high for longer is the same thing that your average working American man and woman see, and that's headline non-farm payroll growth.
Right.
Forget the fact that 800,000 dropped out of the labor force in December. Let's just push that away. If they hadn't dropped out of the labor force, the unemployment rate would have gone up to 4.1%. But Jay Powell is on a mission. He is on a mission to break the Fed put, so the longer he can stay tight, the closer he is to saying mission accomplished.
Are you suggesting that the Fed is using the wrong data?
I'm suggesting the Fed is using what cover it can get. And it wants to continue shrinking its balance sheet.
What do you think should be the appropriate policy this year? How many cuts, if any?
There's this little thing called the federal government. And even though we've just come through a patch of pretty good economic growth, there's still Congress, the White House, spending like we're in the Greater Depression. So if I'm the Federal Reserve and I'm trying to truly be an independent, apolitical institution, and not appear to be, basically, kidnapped by Congress to do their bidding, I'm going to keep interest rates up.
Why do you use these air quotes? I mean, evidence that they're not.
If you're independent and you're apolitical, then you do what's right for the country.
Right.
And doing what's right for the country is making sure that Congress quits spending like drunken sailors. And how do you do that? You jack up the interest service costs for the country. You're going to hit $1 trillion here in about 5 minutes.
What is better for the average American? 5.25% Fed funds rate or 0? I'm giving you 2 extreme examples here.
Oh, definitely 5.25%.
Really?
Absolutely. Oh my gosh.
The average person would disagree with you. I don't want to pay higher interest rates on my credit card. I don't want to pay a higher car loan. But explain your thought process here.
Look, living beyond your means never ends well. Now, try and tell this to a 20-year-old, and they'll be like,
I understand.
They'll be like, TikTok disagrees with you.
Sure.
And I get the nihilism, and we're never going to be able to afford to buy a home anyway, so why bother?
Yeah.
I mean, of all of the homes in the United States of America with 3 or more bedrooms, 40% are owned by baby boomers, 20% are owned by millennials.
Right.
So you see where there's this kind of doom and gloom. Screw it. I'm just going to live and live well. I'm going to go out to dinner wherever I want. I'm going to take whatever vacation I want because I'm never going to even be able to own a home. But for that, the reason that this occurred in the first place was that the Fed was too low for too long.
Right.
And they bought up a third of mortgage-backed securities and set off speculation in the housing market that made it too expensive to buy a home.
Yeah.
So no, if you ask me 5.25 or 0, 5.25.
Let's talk about this chart here. Very important for the market. Speculative U.S. corporate debt, preemptively refinanced a year out. We're still concerned about refinancing risks, Danielle?
Well, we're going to get concerned in about 2 months. We haven't been concerned in about 40 years. Because every single time that there's been what we call the wall of maturity, the Fed funds come in, the Federal Reserve comes in and slashes and burns interest rates down to the zero bound and prevents a default rate cycle from ensuing.
Maybe explain to the audience, what is the wall of maturity?
A wall of maturity is companies see coming that they have refinancing to do. But it helps if you can refinance at zero.
Right.
Today, your average company that's refinancing, they're seeing the cost of refinancing go up 40%. And because the Fed has not lowered interest rates, which it normally would have done in this cycle by now, at least since Greenspan was in office. Not Paul Volcker. Paul Volcker would have given the middle finger. But since Greenspan was in office, by now we would be back to zero. So companies have never had this kind of moment of truth where they had to refinance to a higher interest rate, to a higher coupon that they have to pay on their bond. But it's happening, and even though technically speaking, the maturities don't really begin to increase dramatically until 2025, the first quarter of 2025, for accounting purposes, the minute any company's liability debt has a 12-month or less maturity, it's reclassified as a current liability and your financials get hit.
And this is happening when?
It's happening in March.
So what can we expect? Lower earnings per share across the board?
You're going to expect companies to continue doing what they've been doing so aggressively in the current fourth quarter earnings season. And that's that you get an earnings report accompanied by another line item that says, and we're going to do big layoffs to cut costs. Because if you have to spend more on interest...
Why not just jack up prices on their items, goods and services?
That's another line item in the current earnings season release. They're saying, we're trying and failing. We're no longer able to push through price increases. We're getting major pushback from consumers. So much goods have been bought forward and people's paychecks are shrinking. This crazy wage inflation that was a thing in 2021 and 22 is gone.
Do you believe that high interest rates, hear me out, are actually inflationary precisely because the extra costs are passed to the consumer through higher prices?
To the extent that they can be. But corporate America is telling us in no uncertain terms, we cannot pass these higher prices along. That's why we're firing all these people.
Right.
Because one way or another, we have shareholders.
I know nobody knows for sure, but at what level of unemployment rate would you as an economist look at to see, okay, look, we're in a recession?
You know, I think given how long and how low the unemployment rate has been, a low in this cycle of 3.4%, which was, 1969. I mean, a long time ago that we had a 3.4% unemployment rate. I think once we cross that Rubicon to 4%, we're in the soup. And again, what we're seeing from the Bureau of Labor Statistics is one negative revision after another, after another, after another. So they're revising away the happy headlines that most households read on the Saturday morning after Friday non-farm payrolls are reported. But they're being revised away. We actually saw the quote-unquote birth-death model, which had added 1.3 million jobs in 2023 alone. 40-some-odd% of job creation was imputed using a model based on companies based on the economy giving birth to all of these economies in the middle of the worst bankruptcy cycle since 2010. So that's going to be revised away too. And in fact, in December, we finally saw the first negative print on the birth-death model. First month of negative prints. So the tide is definitely turning. And the odds are, because we had 50 states with rising unemployment rates in October, the odds are that we're going to look back one day when the National Bureau of Economic Research finally delivers their verdict, and they're going to say the recession started in October of 2023.
Yeah.
And now that we have these downward revisions in hand, and by the way, that affects industrial production. When you push downward payrolls, when you push negative revisions through, that reduces the hours that were worked that went into computing what industrial production was, which is also a big determinant of recession. It's all connected, and it's all being revised downwards.
I'm curious to see how consumer spending and demand and ultimately retail sales will be affected this year by this particular chart. This is interesting. I didn't know this. Aspirational consumers have had their net wealth damaged. I mean, I didn't think that the rich would actually have their net wealth reduced this year. What happened there?
Well, so a lot of and I call them aspirational, right? Because they make between, and this is annual census data, they make between like $125,000 and $250,000, more or less, don't quote me.
Right.
But they make good incomes.
Yes.
They bought homes when the pandemic hit. They bought cars when the pandemic hit. They have student loans that are that they now have to repay. They make too much money to qualify for student loan forgiveness.
Yeah.
Their obligations are overwhelming them, and they took on credit card debt.
Yes.
So it's not one thing, David. It's a bunch of things added up. But this particular cohort of income earners who are responsible for 20% of U.S. consumption, just this one cohort I'm talking about, has seen their net worth decline.
How do you explain this chart then? The quit rates have been falling.
Quit rates have been falling. Of course they have.
Isn't that good?
From the perspective of the employer, sure.
Oh, okay.
But a rising quit rate, I call the easiest way to think of the quit rate
is
okay.
I see what you're saying.
The take this job and shove it rate.
Right.
So you can tell whoever's employing you to take your job and shove it. I can go get another job that pays me more.
So it doesn't mean that people are content with their jobs and they see stability in their current positions. They don't need to leave. But when a higher quit rate happens, it's usually because people are confident they can get a better job, hence the economy is booming. Am I explaining that right? Yeah.
And that's why in 2021 and 2022, the people who were what we call job switchers, jumping from one job to another, their wage inflation was way above people staying in their jobs.
Right. Okay, so ultimately investment implications this year, how are you allocating your assets?
So, we saw, if you look at FactSet data, we saw that the third quarter earnings season was like barely positive earnings per share, barely positive, after 3 quarters of negative earnings. And now what we're seeing midway through the current earnings season for the fourth quarter is that the negative earnings are getting deeper and deeper and deeper with each week that passes because companies are missing. And that's why you're seeing so many earnings reports saying, we missed on our top line, we missed on our bottom line because we can't. Well, that's different. Why are 7 stocks going up? Because inflows to 401k funds have yet to reverse.
Dow Jones hit an all-time high today as we're speaking,
Okay.
I don't know why.
But look, there is a structural aspect to the stock market.
Right.
And a buddy of mine, Mike Green, who follows he always says, just follow the money. Follow the flows.
Yeah.
So as long as people who make enough to contribute to their 401ks.
Right.
As long as the number of those employees, especially the ones with employer match, as long as that number is growing or even stable, those 7 stocks are going to keep going up. The major indexes are going to keep. His concern right now is that because we were just talking about Amazon's third round of layoffs, his concern right now is that layoffs and good paying jobs have been going on for so long that there's the risk in 2024 that we see reversal of the momentum in the 401k inflows to being outflows. That's a game changer for index investing when 53% of outstanding right now is in passive funds. So for the first time, you now have more in passive funds that are fed by 401k flows than you do in actively managed funds.
Interesting. I just thought about this possibility because the Fed is reducing rates this year, cutting rates this year. Possibly could we get a divergence between the real economy and stock markets like we saw post-pandemic, where the real economy isn't doing great, but stock markets continue to reach the all-time highs. Is that the base case scenario for you or not?
That was 2023.
Okay, yeah.
That was 2023 because the only thing that looks good about 2023 is consumers borrowing to spend and the headline unemployment numbers still looking good on the surface.
Yeah.
Under the surface, they look awful.
By the way, credit card delinquency rates is another slide you have here, but according to the St. Louis Fed, it's now at 2.98%, which is higher than the pandemic. It is the highest level since 2012.
With an unemployment rate of 3.7%.
Yeah, what is going on here? Because you would think that, again, yeah, everyone has jobs. Why can't they pay back the credit card debt?
And they're taking up buy now, pay later, which doesn't factor into the picture that you see of consumer debt.
Yeah.
It doesn't even get added. So in the month of December, when we had below out retail sales,
Right.
credit card debt went up $55.8 billion in a month.
Right.
We've never seen anything like that. Buy now, pay later, $19 billion.
Okay, so I'm guessing you're defensive this year with your allocation.
Between Discover Financial, Ally, Synchrony, all the regional banks, the charge-off rates, the money that they're losing on credit card losses are so big that lending standards are going to tighten. So people's ability to access more credit is going to be impaired. Don't get me wrong, Americans will keep on, they're heroin addicts. They will keep on spending as long as you give them credit. As long as they have more credit, they will keep on
Should
spending.
we short banks, Danielle?
Banks have been beaten up. So as long as banks are really aggressively writing off these bad debts, they're going to put themselves in a better position. But there are a lot of lenders that are there are a lot of lenders at risk, especially the ones who are providing financing to these buy now, pay later firms, where you can put groceries on an installment plan. I mean, groceries. Buy now, pay later was originally conceived as something that was always backed by, I'm going to buy a piece of furniture. So if I renege on my obligation, then the lender could go get the piece of furniture. You can't do that with groceries. So, but that's how far gone we are with Americans and taking on debt.
And what about we're at a resource investment conference? We have to talk about the precious metals. How does gold usually perform during a rate cut cycle?
Gold will outperform when rate cuts are for the purpose of combating recession.
Interesting.
And that's why there's a certain irony that investors and households are they're cheering for the Fed to lower interest rates to the zero bound, but it's not good news if they do that. It's a lot. I mean, if the Fed is able to just lower interest rates 3 times this year, like 5.25 to 4.5, I mean, in theory, there's no recession.
Right.
But all those companies that need interest rates to go back to the zero bound so that they can refinance their debts, they're in the soup.
Which
75 basis points, 0.75 percentage point in 2024 doesn't help them.
Which asset or assets do you think will perform the best this year?
So I think your treasuries are going to perform.
Okay.
I really do. And there's a reason that we have not seen the yield curve uninvert yet. It's because the Fed is accomplishing its mission to stay high for longer. And in the month of January alone, there's going to be $75 billion that rolls off the Fed's balance sheet. You know, we don't have the same cushion in the financial system that we had in 2023 because there's a facility that the Fed created, which created a synthetic, very short-term treasury bill.
Yeah.
That has been largely depleted from $2.5 trillion to heading towards $0.5 trillion, and they say that by May it's going to be completely emptied out. So the liquidity cushion in the markets is also not what it was in 2023. So there's a higher risk of an accident happening.
Corporate debt, interest rates are going down. Is that good?
If they go down enough, but they need to go down to zero.
Right.
They don't need to go down by 0.75 of a percentage point. That's still going to represent a doubling of a company's coupon when they go to sell the bond to replace the one that's
Right,
maturing.
right,
Doesn't
okay.
help him if your interest costs are still doubling.
Tell us about QI research, some of the other research you've been doing besides the presentation you're making here at RIC.
So, a lot of the research that we've been doing lately at Quill has been on all of the other body of data that are at recessionary levels. Literally, the only data that are not at recessionary levels are credit card and debt and fiscal spending on job creation, government jobs, social assistance jobs, healthcare jobs, all to help support the welfare state, plus leisure and hospitality. When you add all those up for 2023, that was 81% of the jobs created. Productivity is taking it on the chin. Productivity is getting annihilated in this kind of environment because the only people getting new jobs are for non-productive endeavors.
Yeah.
And it's all based on Uncle Sam. I mean, you had 25% of hiring last year was government jobs alone. In the past, every single time government jobs creation has been 10% or more, you're in recession. So we follow the manufacturing sector. We follow Empire State and Philly Fed, and these numbers are, again, they're not late cycle. They're not recessionary. They're deeply recessionary. So we follow all the other indicators while we wait for the government's bean counters to play catch up at QI Research.
Okay, fantastic. Follow QI Research in the link
QI
down
Research
below.
at DiMartinoBooth.substack.com.
Yeah.
I promise I won't raise my Daily Feather rates, so come and subscribe and follow me on Twitter at DiMartino Booth.
We'll hold you to that promise. Thank you very much, Danielle.
Great to see you, David.
Good to see you in person, and thank you for watching.